Dear Daily News Report viewers, after watching this video, you can find previous videos by clicking on the top right button. We recommend watching, subscribing, and sharing. Thanks in advance. Will the market crash when Fed stops the stock market pumping? The incredible rise in the stock market since the coronavirus collapse does not represent the old-fashioned market reality. I will not say that this does not reflect the truth, because it is. The fact is that the Federal Reserve and the United States government pumped so much money into the economy that it kicks like a pair of broken frog legs in a biology experiment, while the tremors of the current are injected into dead meat. It seems to the audience that the organism is alive to a very limited extent, but we all know that the whole creature itself is dead. As soon as the current decreases, lifelike behavior ends. Fed liquidity pumps and stock market rises. Now the Federal Reserve says it is not looking at the stock market end. As a result, it is pumping to keep the credit markets alive. And when the stock market rises, obviously this cannot be entirely true, because if the stock market is too much, it will pose a major threat to the system. If you look at the credit crunch of 2007 onwards, the destruction came from the credit markets. The bond markets are the senior markets. Equities are junior. So if the stock market crashes, that is very bad and needs to be watched out for, but if the credit markets die, then it's all over, period. As such, pumping to keep the credit markets open and leaving equities to look after themselves makes sense. But nonetheless, the outcome is to make the stock market no longer a free, efficient market and instead create a real bubble in valuations. The stock market's levitation from its crash is absolutely correlated with the Federal Reserve pumping money into the system. And now it's stopped, at least temporarily. In the week to June 15th, the Fed pulled money out of the market. This begs the question of why? Does the economy no longer need stimulus? Has it had too much? Clearly it is the latter, and why has it been overstimulated? Why is the indicator for that? It's the stock market's overperformance. The Fed has pulled money out to stop the stock market going vertical into a bubble doomed to crash. So I'm going to amend this to, I thought I would have to modify this map more, but I haven't had to. The comfort zone still looks like a good range to me. Now we have a top in the place. It seems clear to me that the Federal Reserve has pulled out money from the markets to check the runaway rise of the market, now powered by the fear of missing out. The crypto crowd raised on wild Bitcoin swings have turned up at the stock market and are doing their FOMO to the moon things with stocks. This is great, but we all understand the danger of a stock market going vertically up without there having to be the biggest recession since the birth of the Industrial Revolution in progress. So what now? The markets are no longer free. They are highly moderated and filled with inefficiencies that should be a license to make money for the smart. Politics is in charge. The markets will not be allowed to melt down. Where that meltdown red line is on the chart is a guess, but the above chart is probably roughly in line with the bottom range. The government and its agencies will nurse the markets along for the years necessary to get back to an equilibrium of call. We have had that since 2008. Expect more of that kind of creation until and only until a happy outcome or a colossal breach. To keep things going, the powers that be will pump when the market goes low and pull liquidity when it overheats. This will produce big swings. What to do? Buy the big dips and sell the rallies. This is a pure trading market defined by the liquidity injections of the Fed and government stimulus. In the coming period, we can guess that if the Fed is pulling money from the market, then it's because the stock market is too high, and it will take a fairly significant drop to make them comfortable about levels. Action in the credit market will be all important, so if the credit market seizes, then they will flood markets with new cash to reopen them. If necessary to avoid a defining market malfunction, they will rebase the value of money to get to a position where support is impossible or unnecessary. This is going to take a long time of crazy markets. As such, the only way to go is to stalk the Federal Reserve's policies and hope you call them right. For now, it seems time to think about the high probability of a correction. The market is way too high, and without new money, it will fall back. Right now, with the world in various states of economic lockdown, things are only going to deteriorate further, so unless there is a miracle or governments choose to go full Zimbabwe, there has to be a pullback. But going full Zimbabwe is an option. So the real situation is any way you turn, these are incredibly stormy seas ahead. Equally frustrating are the interviews with money managers on the national cable stations. Almost all begin with statements about how the stock market is overvalued. But when the interviewers ask if that means to sell all stocks, the answer is a complicated version of "I don't know." Where is the conviction? It's easy to see why conviction is absent. This is an incomprehensible market for many analysts that thrive on quantitative analysis, historical patterns, and even technical analysis. Those that need a clear path from point A to B are out of luck right now. As a fallback, market strategists express a range of likely outcomes rather than driving a stake in the ground. They draw no conclusions with that approach. This is one of the reasons why investors have collectively parked $3 trillion on the sidelines. In this market, negativity has momentum. Warnings abound, but are they totally justified? Real market alarms can mitigate losses by alerting us that the market is or soon to be in trouble. But with the too frequent use of extremely negative narratives, the words are relentless, and false alarms so frequent that investors could become desensitized. The best analysts for our current situation are those that thrive on uncertainty, look for signals in the noise, and can think very broadly about the current state. These analysts understand that the fear of loss is much greater than the desire for gain, and maintain that awareness when reading sensational articles that abound in our world right now. They also look for new patterns in how markets react to news. There is much discussion about when or if a vaccine will be developed. I do not notice the market's hair trigger sensitivity to vaccine news, good and bad. These are rare data points, provide a hint about how the markets will react when there is concrete vaccine news, positive or negative.
Dear Daily News Report viewers, you can find other videos by clicking on the top right button. We recommend watching, subscribing and sharing. Thanks in advance.
Most of the idea, comment, information and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is wise to consult an expert before making this decision.